common question that I get is, why is it that in my whole life policy that I have to go backwards to start off? Why can't I put $1 in and get $1 out? Where's the money going? Who's it going to? What's it paying for? And today we're going to answer that question, and we're going to help you see that even though you're going backwards, you're actually paying for something that has a lot of value, and it pays for itself over time, and we'll look at how it pays for itself over time. So number one, the first reason that you go backwards in a policy is you're paying for a tax shelter. So it has tax benefits. That has a cost. Number two, you're paying for the commissions and operation of a mutual life insurance company to function. The sales team, the customer service team, the actuaries, the lawyers, the leadership team. To function a company, it costs money, and you're paying for it by paying for your policy. And number three, you're paying and getting for a death benefit. So you're going to go backwards to start off a life policy because you have to pay for those three things: tax shelter, commissions and running a company, and then the death benefit. Let's dive into the numbers. I've done the numbers previously. All of them have been done via truthconcepts.com, but I'm doing that. They'll already be done for you. So let's dive into the illustration and start looking at it. In this scenario, we have a 50-year-old male. Year one, they put in $37,000. They're going to put in $12,000 a year ongoingly. It does tail off eventually and decreases. By age 85, they make their last premium payment, and they're done paying premiums the rest of the time. We'll come down to the bottom of this page in a little bit in a second. Now the question is I put $37,000 in. Why do I not get $37,000 out? What is happening to my money that's resulting in me not getting my $37,000? Again, it's the tax shelter, paying for the company, and the death benefit. Now, here is the question. How much does this cost to get this death benefit? And two, what is it going to produce for me in the future? Does it have a rate of return? Is it going to be a positive cost for me, or is it just going to be a sunken cost I lose out on? And so the best way to think of it is I put the money in, but it will produce something for me down the road. So first off, we have to find out how much does it cost. And the way to find out how much it costs is we take what is the difference between what we're putting in and how much we get out. So in year number one, I put in $37,000 and I only get $32,000 out, a difference of $4,099. In year two, I put in $12,000 and I only get $11,132 out, a difference of $868. And we keep doing that until it breaks even. So if you see here in year six, I put $12,000 in and I have more than $12,000 available, which means I'm no longer having to pay for my own policy. I have a storage vehicle just like a savings account. I put $12,000 in and I get $12,000 out. Okay, so the total amount that it cost over that time frame is $6,602. That's how much it cost you to pay for the tax shelter, to pay for the death benefit, and to run the mutual company for having the policy. That's the difference between what you've put in and what you've gotten out after year five. The question is what does that turn into? And so the way that we can calculate that is we'll come down to year 85. We're going to look at how much we've contributed. So we've contributed $350,000, but inside of our cash value, we have $715,000. So we've contributed $355,000, but we have $715,000 in cash value. So it's grown bigger than it was. If this had been done in a different account, in a non-tax sheltered account, how much would you have had to pay in taxes? The answer to that question, to get that same amount of growth, the answer to that question is you would have had to pay $200,000 and $453,000 in taxes. So because your money's in the whole life policy, you have $200,000 more dollars than you would have had you had this in a CD or a money market or a savings account. That equals a 9.95% return, an ROI of 9.95%. I paid $6,000 up front to get the tax shelter, and it produced a 9.95% ROI for me because it produced $200,000 in tax savings for me over that period of time. Now let's look at the death benefit, which you paid for, which we can also calculate. So the death benefit at age 85, let's say we passed away, is $826,000 in death benefit. But you have to minus your cash value because that's how it works. Because you're minus, they pay you the 826, and then they give you the cash value, net that. So that total between the cash value and the death benefit is $110,000 and $316, which means you're getting a $110,000 death benefit in total. When you get the cash value plus death benefit, you're getting the full 826, but you have to realize that some of that's coming from your cash value. And I paid $6,602 for that death benefit, and because I paid that early on, it gave me an 8.14% rate of return on my money. I put in $6,000 and it produced $110,000 at age 85. That's a pretty good deal. So even though you're going backwards, you've created a 9% rate of return on the tax side, and you've created an 8% rate of return on the death benefit side. To me, that's worth the cost. That's worth going backwards, specifically since I know that I'm going to get steady growth and I'm going to break even, and I can still go do all the other things we've talked about in other videos where I can take advantage of a tax play, or I can do XYZ investment, or I can take advantage of purchasing XYZ business. It enables me to have that ability, and it's going to perform better than my savings account would have, even though I'm going backwards, and I'm okay with that cost. And I hope this video helped you be okay with that cost too. Until next time.